It's important to note, too, that while gold is not merely at nominal all-time highs, but probably in constant dollar all-time highs, silver is far from an all-time high. $57 comparing to 50 forgets the fact that 15 years has passed since the last time they were 50. The dollar's deteriorated.
When analysts say the LBMA is illiquid, that's true. That its inventories are low, that's true. And that it struggles to source metal within 30 days, the response should be simple by the members and the LBMA itself. Source the metal, activate supply chains, pay whatever is required, bring inventory in. The LBMA oversees a franchise that is effectively the gateway to Western precious metals markets.
The sharp upswing in speculative positioning across silver-linked equities signals a notable shift in market psychology, yet analysts emphasize that the sector remains far from the euphoric conditions seen in past commodity manias. Rick Rule points out that early inflows into silver miners often begin quietly, with seasoned investors accumulating before retail enthusiasm takes hold. Historical precedent shows how dramatic these cycles can become. Previous silver booms transformed obscure micro-cap explorers into multi-billion-dollar stories almost overnight, driven by rapid repricing rather than slow and steady appreciation. Today's activity appears to mirror only the earliest stages of that pattern, where interest is rising, but widespread excitement has yet to ignite. Rule adds that the fundamental backdrop for producers remains exceptionally important at this stage of the cycle. Most primary silver miners operate with costs clustered near the $20 level, meaning recent gains in spot prices have only started to filter into earnings. Complicating the picture is the heavy reliance of global supply on mines where silver is a byproduct, effectively delaying the sector's sensitivity to price moves. According to Rule, the pivotal moment historically arrives when major producers begin reporting significantly stronger quarters, triggering a wave of institutional capital into both top-tier operators and emerging juniors. Until that catalyst appears, the market builds pressure quietly, often setting the stage for abrupt surges later. Looking forward, Rule's long-term arithmetic frames a compelling scenario. If ongoing currency debasement persists, nominal gold valuations could multiply over the next 10 years, with silver historically amplifying gold's movement by a factor of 2 during mature bull phases. Past cycles have shown that leading silver juniors can deliver leverage of 2 to 1 or greater relative to the metal itself, creating the possibility of outsized returns for disciplined investors willing to withstand volatility. Rule stresses these are not guarantees, but probabilities grounded in decades of market cycles, suggesting that the current slow build in silver may be the opening chapter of a far larger narrative still unfolding. Now, we present the clips from Rick Rule's interview. Before we continue, please subscribe to our channel and activate the bell icon to receive timely updates. Thank you, and enjoy the video.
When the momentum in the gold price attracts generalist investors to the space, market leadership changes from gold to silver. This will be the fourth time in my life that this occurred. It looks like in the market that transfer is taking place as we speak. Whether or not that's true, of course, time will tell. When leadership transition does take place, silver outperforms gold pretty dramatically. And the high-quality silver stocks outperform any other extractive asset class I know. I hope you paid attention to the part where I said high quality, though.
Yeah.
There are a lot of purported silver companies that litter the speculative landscape who unfortunately have no silver. Those can uniformly be expected to do well, too, for a little while, but they're treacherous places to be. We haven't had the type of move in the silver market that would allow the senior producers' margins to increase as dramatically as the gold producers have. The strength that we've seen in the gold market for the last 18 months has a lot to do with the fact that they're making so much money. Yeah. The silver guys haven't had that happen to them yet.
They must be getting close, though, don't you think?
You bet. Only about 18% of primary silver supply comes from silver mines. Right. 82% comes from copper mines or lead mines or zinc mines. One could say, as an example with Freeport-McMoRan, that their cost to produce silver is zero because their mining costs are paid for by copper. They just have to strip it out of the stream. The real silver producers, the Pan Americans of the world, the Fresnillos of the world, the Buenaventuras of the world, the real ones, are nominally $20 producers, but
So their margin now is almost 200%.
margin's good. The margin's good. Now, it is likely, although not certain, that one of the ways that they got through periods of low silver prices was by producing at mine grades that were higher than the average reserve grade. That's a fancy way of saying they high graded. And that will impact their results for a couple of years going forward, because it is unlikely that they haven't picked the eyes out of some of the pockets they've mined. So you have to deal with that.
Yeah.
The market is going to need to see a bang-up quarter out of Hecla, or a bang-up quarter out of Core, or better yet, both.
Yeah.
A bang-up quarter out of Pan American, and they're going to see that. It's important to note that most of the real silver companies are gold companies in drag. More than half of their revenues are gold, but they're still extraordinarily leveraged to silver. It's important to note, too, that while gold is not merely at nominal all-time highs, but probably in constant dollar all-time highs, silver is far from an all-time high. $57 comparing to 50 forgets the fact that 15 years has passed since the last time they were at 50. The dollar's deteriorated. An investor who is prepared to stay the trade for 5 years is by no means too late. Let's look at the arithmetic. 2 interviews ago, not the one in Zurich, but the one before that, we talked about the fact that I believe that over 10 years, the US dollar loses 75% of its purchasing power.
Yep.
If it does that, I would expect that gold would maintain its purchasing power, which means that over 10 years, I see gold in nominal terms between 3 and 4 times higher than today. In prior bull markets, once the crossover has occurred, once silver begins to outperform gold, the performance in silver is roughly double the price of gold. I'm not saying to you that silver is going to go 8-1. What I am saying is that a move higher in silver, from my point of view, is statistically extremely probable. If one looks at history too, the higher quality silver juniors outperform the silver price 2-1. So if you follow that arithmetic progression, what I'm saying is that there's a possibility, if not a probability, that over 10 years, a portfolio of high-quality silver juniors could give you a 20-1 return. Your investors shouldn't think in their mind, Rick Rule just said that Amalgamated Moose Pasture Silver is going to be a 20-bagger. I'm not saying that. I'm saying if you follow the arithmetic progression, that there's a very good probability that a carefully chosen portfolio of high-quality silver juniors has the potential for persistent and tenacious speculators to generate a life-changing event. The last period of major dollar instability in my lifetime was the decade of the 70s. The US dollar again lost 75% of its purchasing power, and gold went up 28-fold. If you had told most people, myself included in 1970, that gold was going to go to $800 from 35, I would have accused you of smoking a then illegal substance.
Right.
The second piece of arithmetic is simply that number, the deterioration of the US dollar. We covered in a prior interview the debt owed by the US government and the ability or the inability to service that debt. The inevitability that they inflate away
Yeah, well, they have to.
their unfunded liabilities. So, those are 2 important pieces of math. The third piece of math is this. While gold has performed in a way that you and I understand, most of the investment community still can't spell gold, despite the fact that it's a 4-letter word. It is very, 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 very underowned.
Momentum across the silver market is intensifying far more quickly than many observers expected, and Vince Lanci points out that the subtle shifts seen over the past year have now evolved into unmistakable structural pressure. Physical inventories are being drawn down at a faster pace, industrial buyers are locking in long-term supply to avoid future shortages, and institutional money is steadily reallocating toward assets that cannot be devalued by policy decisions. This gradual but persistent migration into tangible stores of value signals that the market is preparing for a recalibration. The combination of thinning warehouse stocks, tighter global supply chains, and stronger long-cycle consumption is forming a foundation that typically precedes major directional moves. These forces are now converging in a way that reduces the ability of the market to contain or manage price discovery. As supply constraints deepen and production becomes increasingly strained, financial markets are beginning to respond to the reality that a metal with this level of industrial dependency cannot remain undervalued indefinitely. Broader economic uncertainty, rising geopolitical tension, and accelerating demand from emerging technologies are amplifying the underlying pressure that has been building for years. Silver is entering a stage where external interventions lose their effectiveness, and the market's natural response is to reprice sharply once constraints reach a critical threshold.
Gold is up 12, mid-range on the high end. Silver is up 50, gaining momentum. Those two markets were lower during Shanghai and caught a bid at 4 a.m., which, by the way, is indicative of Shanghai. Talk about that in a second. Copper down 5 cents, WTI up 20, natural gas down 10 as the profit taking really emerges. I guess the cold wave isn't that bad. Bitcoin is almost perfectly unchanged. Ethereum the same. Palladium down $1.75. Platinum up $1. Gold, silver at 71 and change, and the grains are mixed, with corn up a penny. That's palladium. In 1999 to 2001, it was squeezed by Russia. I want to discuss that a little bit and give you a preview of what we just sent out to subscribers. So Russia's escalation of gold supply restrictions may signal the start of a coordinated sovereign squeeze on physical metal heading into 2026. Now, this post that we just sent out examines the escalation of Russia's proposed ban on gold bar exports beginning in 2026 and why it matters for global bullion markets. Taken alongside Moscow's existing scrap export ban and China's withdrawal of gold from SHFE circulation, the warrants, the move points toward a broader effort by producing nations to internalize precious metals flows. Russia has used similar tactics before, most notably in palladium, to tighten supply and reshape market pricing. With additional actions emerging across BRICS and Asia, these policies suggest a developing squeeze on available physical gold. At the same moment, sovereign demand and monetary stress are intensifying. But there is more in that post. We include a complete dossier of the palladium squeeze Russia participated in early 2000s. Now, it's easy to call it Russia squeezing us and demonizing them, and I'm all for it as well. However, far be it from me to accuse Russia of manipulation. It's not manipulation when you tell people what you're going to do and you do it. All they did back then was let the market force the West to recognize Russian pricing power and snap out of their denial at how important Russia and South Africa were to the palladium trade. We know it. We lived it. Now they're aiming to do the same with gold, we believe. Putin, if nothing else, is a world-class commodity trader. He did it with palladium. He did it with nat gas. And next he can do it with gold. And this time he's not alone. He's got China on his back. That continues in the premium post, how Russia can and will squeeze global gold. Next, news and analysis. Yesterday, India says silver is money. That's a story about it's a news item, actually, out of India describing how they are encouraging domestic holders of silver to use it as collateral for loans as opposed to just selling it to get the money. So that's a restriction on supply. TD's golly, silver squeeze done, platinum pump next. We like to talk about that for a second. The term, in the context of the silver squeeze concept being over because of the large inflow of metal into London. We'd like to address that on the merits of, on the future of the LBMA and the future of Western pricing power. The term liquidity gets used constantly in finance. In many cases, it is overused. Still, it matters. Liquidity referring to, do we have enough silver to deliver? Do we have enough money to pay our bills? Liquidity means the ability to transact in a timely fashion. It means having cash or cash equivalent assets on hand to meet normal business demands. Most firms manage liquidity on roughly a 90-day forward basis. That is standard operating practice and basic risk management. But illiquidity, left unresolved, becomes something far worse. It becomes insolvency. There is a simple rule in finance. If you are illiquid for 90 days, you are insolvent. In fast-moving markets, even 30 days can qualify as insolvency. Why? Because being illiquid means waiting for incoming receipts before paying ongoing obligations. It means telling creditors and counterparties, spot me 30 days until our cash comes in. That can work temporarily as long as the inflows ultimately offset outflows. But when those offsets fail, when receipts do not cover obligations, the business is no longer illiquid. It is insolvent. The principle applies to money, and it applies equally to inventory. In silver's case, the inventory is the money, or increasingly. It is increasingly being viewed as money again, evidenced by the India news. So when analysts say the LBMA is illiquid, that's true. That its inventories are low, that's true. And that it struggles to source metal within 30 days, the response should be simple by the members and the LBMA itself. Source the metal, activate supply chains, pay whatever is required, bring inventory in. The LBMA oversees a franchise that is effectively the gateway to Western precious metals markets. But when delivery times are marked at T plus 60 as they were, or T plus 90 as they were implicitly, that is not simple illiquidity being disclosed. That is an admission that inventory is unavailable. That is moving from illiquidity into insolvency risk. Why such a strong word? Because if you cannot conduct normal business for 90 days, if you cannot replenish stock and cannot meet deliveries, your supply chain is effectively broken. And when supply chains break, businesses fail. Now, we are told that liquidity is returning to London. We do not doubt that. The metal is flowing into London, as Daniel Galley says. There is metal flowing back into the LBMA vaults, bottom line. All right, let's assume that is true. But the larger issue remains. When a business delays payment for 30 days, 60 days, or halts transactions altogether, trust is broken. Payment chains fracture, counterparties now move elsewhere, workarounds emerge, alternative channels develop. We are watching that happen now. So even if London's liquidity is improving, its credibility has not recovered. The problem is no longer whether metal happens to be present this week. The question is whether this renewed liquidity is a temporary patch for a structural failure. A refilled vault is no longer enough. What must be repaired now is trust, and trust cannot be revaulted overnight. Will the LBMA actually deliver the metal it has restocked, or will it shift towards hoarding, as others already have? Until those questions are answered, confidence does not return. They are structurally insolvent as far as we're concerned.
The trajectory for silver is increasingly pointing toward a disruptive repricing event as multiple long-building forces converge and strain the market beyond what conventional frameworks can manage. Industrial consumption is set to grow at a pace that outstrips new supply, driven by rapid expansion in renewable energy, electric vehicle components, and high-efficiency electronics, all sectors that rely on silver's unmatched conductivity. At the same time, global inventories are thinning to levels that leave little buffer for unexpected surges in demand or geopolitical shocks. This narrowing margin between available metal and required metal is creating a structural tension that cannot remain dormant indefinitely. Once financial markets fully register the depth of this imbalance, capital flows could shift swiftly and decisively, overwhelming the relatively small size of the silver market. Even modest reallocations from large funds, sovereign buyers, or industrial purchasers could spark a cascade of higher pricing as participants rush to secure supply before the window closes. If current trends continue, silver may be pushed into a phase where price suppression mechanisms lose their influence and genuine scarcity begins to dictate valuation. In such an environment, a powerful and sustained breakout becomes less a hypothetical scenario and more the natural outcome of years of underinvestment, rising global demand, and a system approaching its physical limits. If you found this insight useful, make sure to like, share, and spread this update to others watching the silver story unfold. Your support helps keep these deep dive analyses coming.